Good afternoon. Welcome back to another conversation with Jay Hatfield from Infrastructure Capital Advisors, also known as InfraCap. You'll notice we have a little tiny slide up here. This conversation is very timely, as we usually like to chat with Jay, or Jay likes to chat with us after Fed meetings. And now with the Fed cutting 25 basis points this year, or excuse me, just a couple of days ago, with 2026 on the horizon and a potential new dovish chairperson in the seat. There's no better person to chat with to get their thoughts on broader market takeaways and outlook, especially when it comes to like S&P price targets, inflation, fixed income, all the wonderful income-focused products that Jay and the InfraCap team focus on. So just as a quick reminder, just to kind of go through some stuff, and I'm going to turn off the presentation here. Here's a recap as of yesterday. This data is as of midday yesterday, and chatting with one of my colleagues at InfraCap. When you look at the various funds, ICAP, SCAP, BNDS, PFFA, what I call their flagship fund, PFFR, AMZA, and they did recently launch a UCITS product overseas with Han ETF. I'd love to hear how that's going as well, Jay, if we can get into that. For those that are also interested, here's the two Hoya capital funds that we are involved with, Homes and our high dividend yield ETF, RIET. In today's conversation, I thought we would focus on the following topics just because it's very timely. Jay just had his monthly webinar yesterday, and these are some of the topics that they're talking about right now. Interest rates and Fed policy outlook, what's happening with the Treasury bonds, its S&P 500 price targets, inflation in 26, CPI, AI, why they prefer large cap dividend stocks, small caps, and high yield fixed income. And again, because I'm selfish and it's always about me, what Jay thinks about the world of REITs. So with that, we will wind up with audience Q&A. If anybody has any questions and you'd like to get in touch with InfraCap, feel free to call to my good friend Craig Starr. Here's his contact info above. You could sign up for their monthly economic webinar link here. And here's my contact info below. So with that, let's turn this off. Jay, good to see you. It's hard to believe we just did this back in September. Here we are at the end of the year. And really not much has changed since we talked in last September, really. Markets moved, obviously, but another 25 basis points. The 10-year is still at 4 and elevated. There's still no new Fed chairperson in place, and that was talked about last September as well. So, really, let's just get into it. What's new between now and when we last chatted?
Well, thank God we did get a cut, which we could well have not. I think the Fed was very closely divided on that. Obviously, I guess, because there's 3 dissensions. But the one misconception that I would emphasize very strongly, and also turn off my Bloomberg squawk so it doesn't annoy me, is that, okay, I don't know where that's coming from, but in any case,
the walls are talking, Jay. The walls are.
Yeah. But in fact, I'm gonna have to kill my Bloomberg because I don't know where that squawk is. But in any case, the point I'm gonna make is that there's a lot of talk like, oh my God, the Fed cut rates and the 10-year didn't come down, and everybody hates Kevin Hassett. And it's just so simple. We figured this out like a couple of years ago. The 10-year trades 100 over the expected terminal rate of Fed funds. So about 3-4 weeks ago, terminal rate was like 290. Treasury was right around 4. Then we had the Fed meeting. It trades up. Well, actually, it didn't change much, but so between then it traded up to where it is roughly now, like the 310 area. Not surprising, like the 10-year is right at 415. So it's not about inflationary expectations. It's not because the budget deficit's getting wider. It's not because Kevin Hassett is going to lower rates to 0. It's just simply Fed funds terminal rate. And so the notion when the Fed chair says, oh, we don't control the 10-year, it's like most things that the Fed chair says, they're wrong. So they do control the 10-year. It's by the communication they make for what's likely to be the cuts. They said 1 cut in the dot plot. The market's assuming 2. So that's why the 10-year is not at and a quarter. So that's bullish, blinking into your business and ours for rate sensitive securities. You're seeing it today, and you've seen it since the Fed became more dovish. When the Fed's cutting rates, there's a rotation out of tech and into old economy. And we don't think there's a tech bubble, but the Mag 8 is, so we include Broadcom, is very fully valued. And we sold almost all of our Broadcom position yesterday because our target's 400. Well, it's at 400. It was at 420 actually before they reported. So there was some disappointments in their report, but when you go hot into a report trading right, above actually fair value, like 42 times earnings, the most likely case is disappointment, not beating expectations. So that's the setup really for next year. We do think it'll pay finally to be in non-tech, so in REITs, in dividend stocks, in small caps, in preferreds. So preferreds have really lagged. They've done fine, but they haven't really appreciated it. Just you got your dividend. So
Jay,
it should be.
You made a comment that everybody hates Kevin Hassett. For those that aren't as in tune with these things, and I'm not the smartest tool in the shed, but why does everybody hate him?
It's just a political battle. Kevin Warsh is pretty powerful. I think he's a disaster because he caused the great financial crisis. He was on the board Fed board that precipitated it. And he was hawkish after it started. So he's pretty powerful, has alliances. I don't think Chris Waller has a lot, but so, everybody's kind of jockeying to get their candidate in there. So people are taking shots at him, but the data doesn't support their thesis in the sense that if the market really feared that Kevin Hassett was going to be super loose, then that terminal rate would be like 2, and that would imply high inflation. And then the 10-year would be blowing out, not just that the terminal rate went up and it's 100 over that. So the data, like there's a Bloomberg report, markets protesting against Kevin Hassett, is just totally wrong because the data doesn't fit that narrative.
I think it would have been interesting if Reader or Zervos had gotten the call personally, especially for us with the world of ETFs and Reader in that chair. I think it would have been very interesting just to have again one of the top brass of BlackRock running it. All right, so you've touched upon interest rates. You've touched upon what the Fed outlook is: 2 cuts in 26. So you think 50 basis points?
We're at 3, by the way, but the market's at 2.
Okay, but that means 50 to 75. I'm hoping personally for 75 to 100, but I guess we'll see.
Right.
So what do you think this means? Okay, you published. Sorry?
It's not impossible it's 100 because inflation could be plummeting by then because shelter inflation is going to roll over because it's so delayed. We know that shelter inflation is actually down. We do CPI-R. So we know that leads CPI-U. So if inflation's at 175, then the 10-year could definitely be, Fed funds could be at 250.
What does that mean? Again, you may have already said this, but I just want to come back around to it. Right now, as we speak, the 10-year's at 4.1919, if you really want to get to the nitty-gritty. So obviously, all assumptions, who knows what happens tomorrow, let alone a year from today and everything. But let's say there is 2 to 3 cuts in 26, and we're chatting here in December of 26. Is the 10-year still over 4? What does this mean for Treasury bonds and Treasury yields?
Well, this is our key insight that forget all the commentary to the contrary. If you're right, it's 250, it's 350. If I'm right, it's 275, then it's going to be 375 on the 10-year. It trades at 100 over Fed funds. That's the 30-year average. That's the key driver. It's not the budget deficit. It's not global bonds. It's not anything else. So most of the people that you listen to on television are totally wrong.
Did you tell that to Maria today?
What's that?
Did you tell that to Maria this morning that most of your guests are totally wrong?
My target. Those blurbs are pretty small, so you don't get the chance to talk. So it's better to do these type of.
I didn't see any tweets from the president today reposting your stuff, and maybe that'll be coming.
You're gonna get a chance to trash the Fed, so that's what he likes the best.
So, what does this mean for the S&P? Because I know a lot of people come to you for your S&P 500 price targets. As a reminder, just for those that forgot, where were you in September when we last spoke? Where are you today? And what does that mean going forward?
So at the beginning of the year, I mean, it's a little bit complicated, but since we have longer term, I explain it. Beginning of the year, we we're at 7,000, but that assumed a modest corporate tax cut. So then we went to 6,600. And then I'm pretty certain shortly after September, we upgraded to 7,000. And now we're at 7,000, and we've initiated next year at 8,000. And it's critical that we're both of those targets are 23 times earnings. And the way you get there is the average 30-year average is about 18, but the corporate tax cut increased the 30-year average by 4 points. So 30-year average is 22. If we have low rates and AI, which means higher growth rates on earnings, and we are getting higher growth rates like 13 both next year and the following, mostly because of tech, then 23 is justified instead of 22. So 7,000 is 23 times next year's earnings. It's pretty basic, but if you have a year-end target for this year, it's next year's. You look at next year's earnings. And at the end of next year, you look at 27 earnings. So that gets you to 7,000 and 8,000. And our target, as usual, is working extraordinarily well because, you're supposed to fade the stocks, whether it's an individual target or the whole market. You're supposed to fade it when you get close to the target. You're not supposed to just ride it right up to, like Broadcom. We're above our target, and we sold the stock, and that was the right thing to do. So when we get close to 7,000, you should trim, and that's what's happening today, as you are seeing that kind of trimming. And in particular in tech stocks, because those are fully valued by all of our metrics. Some of them are ridiculously valued, like Tesla.
Closed yesterday at 69.01. We're trading at 68.27. And your forecast is 8,000 if all goes well.
Right, which does indicate it's fine to fade it a little bit, but you shouldn't get out of the market. My central message to everyone, which does not seem to be fully appreciated, is that earnings will grow on average about 10%, but it's not magic. It's not because of margin expansion. It's simply the companies are retaining 70% of their earnings. They're investing them on average at 15% after tax. We multiply 70 times 15. That's 10.5. So round that to 10. So don't be too clever and get totally out of the market because you don't like Trump or you don't like tariffs or you don't like the federal budget deficit or whatever flavor of the moment you think AI is in a bubble. You can trim a little, and particularly stock by stock, like Broadcom, fully valued at 410. So trim a little, but then redeploy it because you're going to miss out on that compounding of 10% a year if you try to be too clever. Like you're not running hedge. Most people are not running hedge fund. They're running a long-term investment portfolio, so you want to stay invested.
So we got a boatload of economic data coming out before the Christmas holiday here, even though we're basically at the tail end of the year. And as I like to, tell folks, it's not like PMs are about to make the big size bet going into the holidays. Most of the guys, and again, correct me if I'm wrong, you've been doing this a couple of days longer than me, but by this point, your book is basically done for the year. You might have a little bit of trimming. We're not going to really see any because the SEC is basically shut down at this point. We're not seeing a lot of new deals come into market. So you kind of have a good sense on where we're ending the year and what's going to mean going into next year. So sticking on some of these macro themes, you briefly touched upon it, but let's talk about inflation, because that seems to be one of those buzzwords of 2025, also obviously with tariffs. And that's what we've talked about tariffs a lot in our conversations. But what about your thoughts about inflation heading into the new year?
Well, the critical dynamic, and we saw it for the first time, the last time there was a CPI report, which I think was September, is that finally shelter rolled down to 0.1. So our shelter estimate, so we just take real-time rents, is more like a half, but percent. but 0.1 is like the equivalent of 1.2, half per year, 1.2. So that's a huge relief because what's in the last 12-month number is like 4.5. So that means if we stay down at that 0.1 per month for the next year, PCE core will get to 2%, as reported, not the way we adjusted. Our PCE real time is already at 2. The only proviso, so we expect inflation to print cool. The only proviso is the BLS is equally as bad at reporting inflation as they are at labor statistics. So they do, as inside baseball or masterclass, but they update their, they have 6 different panels of rental data, and they update 1/6 every month. So we might have just gotten lucky, and there's one panel that's actually reflecting reality, and maybe the next one won't, and then the next one will. So look very closely at that shelter number to make sure it's still cooling down to that 0.1, 0.2 level. And if that's the case, then we're going to roll down to this 2%. And then even if the same incompetent people are running the Fed, which they won't be, but we would still cut rates three times. So we're bullish about the data, with the only proviso being we have very low confidence in the BLS reporting accurate data. For instance, in the beginning of the year, normally they rebase financial services. And so if stock prices are up, they say that there's a lot of financial services inflation, which is pure insanity, but they nevertheless will do that. So just, you have to, we know inflation is low and going lower, but the question is, when does the BLS figure that out?
So for those that are watching, just to back up what Jay is saying here, the next report comes out next Thursday. There will be no October data being released. So this is going to be November data that they're coming out with on Thursday. Is that correct, Jay?
That's right. And like I
Okay.
said, you know, you've got to take it with a grain of salt because they're normally bad at doing it anyway, and I think it could be worse than normal. But
And
parse
then,
it, of course. Look at shelter, look at financial services, look at the volatile components. Don't overreact if it's a little bit hot.
and because of this screwed up economic calendar backlog and all that stuff, Tuesday is a very pivotal jobs day. A lot of jobs data coming due. That's usually that stuff that we get at the first Friday of the month. So we didn't really touch upon this in the warm up to this, but I guess I'll put you on the spot since we're talking economic calendar. Looking at my Bloomberg right this second, November change in non-farm payrolls plus 50,000, change in privates plus 60,000, average hourly earnings up 3 ticks, and unemployment rate forecast of 4.4%. I don't know if it's something in your bailiwick, but I'll ask anyway. Thoughts on potential jobs data for this coming Tuesday?
Well, I'd say the same caveat that I have zero confidence in their accuracy. But what we had been calling for all year long was a slowdown in employment. And the reason for that is that the cycle works as follows. The Fed raises rates, the housing sector goes into recession, there's a ton of layoffs, and then you have a full-blown recession. We've had that. So we have a recession in housing and construction. So in other words, negative investment growth year over year. We have that data on our website. That has caused a slowdown employment, but not a recession, because first of all, we never had a big boom in housing, so we're not coming off a big number like we were during the great financial crisis. But more importantly, tech spending is pretty strong year over year, both on the equipment side and of course intellectual property. So no recession, but slowdown in employment. So that's been our call all year. So we do expect that to continue. So I would think it would be weaker than what the numbers, the consensus numbers you described, but with just the same caveat that that's what the long-term trend is going to be. Whether this report is accurate or not is a separate issue.
I mean, are any of these reports accurate? Who's doing the reports? Because who's in the office to actually do the data since everybody's been laid off?
And then just their methodology comes from the 70s. They mail out surveys. It's complete insanity. There's this thing called the internet. You can get, national data on rents. Don't need to send out surveys. Don't need to do panels. Don't need to wait 6 months to update it.
Do they
So,
fill out scantrons and color in their answers and stuff as
I
well,
mean,
and run
it's
it through a
just
machine?
pure craziness. But this is why we don't want the government to run the economy, because they're operating like it's 50 years ago.
All right, so now I kind of have a little multi-layered question for you because it seems like every friggin' conversation circles around AI these days. So, what's your thoughts about AI? And actually, I got a question for you, and I haven't asked this of my buddy Craig, but how does InfraCap utilize AI these days?
So I'll just answer the second question first. All of our analysts do have assistants, so that looks for all the data associated with all the companies they're covering and analyzes it for them. So the productivity of our analysts is increasing because of AI. We've been appropriately built up on AI since it was really first announced with GPT. I was fortunate enough to grow up in Silicon Valley. Not sure why. Maybe my mother just wanted me to make money on NVIDIA when it was created. It took me to a lecture on AI 50 years ago. So they've been working on this for 50 years. So when it happened, I was like, okay, this is a seminal event. And I think that's still the right approach. And all the short theses are a little bit relevant just because these companies are trading at very full values. They're not in a bubble, but they're at full values. So it's okay to fade Oracle if it goes to 350. It's okay to fade Broadcom if it goes to 420. It's not that the world's coming to an end and OpenAI is going bankrupt and Oracle is going bankrupt. It just simply they got ahead of themselves. So we believe that this is the biggest tech trend ever. If you don't use it like we are using it, if you don't use it, you're going to be out of business. And so, but look for cheaper opportunities like Marvell trades at 25 times, same business as Broadcom. Some short thesis out there, but we don't believe in them. So look for something that's undervalued, not massive or not massively overvalued, but totally fully valued.
I want to go more into this. All right. So, teenager Jay Hatfield is sitting with his mother in San Francisco 50 years ago at a conference, and he hears a speech about AI. What does teenager Jay do 50 years ago to, let's say, capitalize on what he just heard at that presentation? Or how did
Absolutely
you
nothing.
implement that, or did it stay with you? No, I'm serious. That 50 years later, you haven't forgotten what you heard, and it paved the road that you followed for many years. I guess you understand what I'm saying? Like, how did you walk away from that lesson 50 years ago that shaped who you are today?
Well, it's just that this was a lecture at Stanford, and my mother rarely took me to these, if it ever. This was like the one time. And I didn't understand basically anything they were saying, other than I did understand it was about artificial intelligence. And so to me, that said, well, this is a really important thing. My mother's, she was a software engineer, thought it was worthy of taking me to this. And it really hasn't happened for 50 years, but now it has. This is a big deal. Like this is something like the holy grail of software and technology. So maybe that was, not an adequate basis for the conclusion. But then when you start to do more work and you look at NVIDIA and say, oh my God, they're completely sold out. They're going to continue to be sold out. You can't just like take this anecdote from 50 years ago and then go crazy and buy everything. But it gave me the
I get it.
intuition to say, this is worthy of more work. We did work on Palantir. We did work on NVIDIA. We recommended Palantir 40 on Fox Business. NVIDIA 300% to go. I know that because it was in my wife's account. IRA, it's up 300%. So it just motivated me to do the work to prove out the fact that, in fact, this is a revolutionary technology.
So we're coming up about 30 minutes here. Got just a couple more questions. If anybody in the audience has questions, feel free to put them in the chat. We will get Jay's thoughts on your respective questions. Jay, in your recent commentary, you focus on three different sectors. And I wanted to pick on those three different sectors individually as you can as your outlook into 26. So, what is it that interests you? We'll start out with large cap dividend stocks.
Mhm. Well, we think there's a lot of super undervalued opportunities there. We had correctly made the call on Morgan Stanley and Goldman about 2 years ago. And with regard to Goldman, that was about $500 ago. So partly because we're in New York City, I used to be an investment banker, kind of can feel when things are heating up. But we have the same view about both private equity firms. So we think they were unfairly punished due to fears about credit, which are unfounded. And then also, it's finally time to buy regular banks. So just like the Citizens Financials of the world, because an upward sloping yield curve is unambiguously great for financials. And then you mentioned REITs, like we really like, recommended our annual letter. GNL is a well-hated net lease REIT that's actually repaired itself, but nobody seems to care. We do think there's a lot of opportunities in REITs. We think that some of the 8 trillion in money markets funds is going to come off the sidelines when the rates actually go to 3 or 275 or 250, because most investors are not economists. They don't really follow the Fed. They just look at their statement and say, oh, my CD is rolling. I used to get 5, now I'm going to get 2. What should I do? Oh, maybe go buy some REITs, go buy some preferreds, go buy some large cap dividend stocks, go buy some small cap dividend stocks. So it's really that simple, that when the Fed's cutting rates, you want to be in non-tech stocks, particularly ones that are undervalued.
So, why small caps then?
Partly just because they're mostly not tech, and they're not over levered, but they are riskier. So when you're coming out of a cycle, there's very low probability of recession. You can go up the risk curve. You could we don't do this, but you could do emerging markets, maybe a little bit overseas, but you want to be in the riskier part of the market. So tech is perceived to be riskier, but it's actually been a safe haven since the pandemic started. So you want to be in the current market's riskiest sectors, which are small caps, really.
What about high yield fixed income?
We do think that's going to outperform. So we have 2 funds there, BNDS, PFFA. We think that regular fixed income, so like BND is our competitor to BNDS. That's an ag fund, so it yields about 4. So that's going to be up a little if we're right about rates and they go to 375 from 415. It's going to be up a little, but not a lot, because when the stock market's strong, spreads tighten and high yield and preferreds outperform investment grade bonds.
Let's get some love to REITs. Let's get some love to PFFR. You mentioned GNL before, but give me a little bit of an outlook for REITs in the new year and give me another pick besides global net lease that's on your radar.
Yeah, well, so I do think that it's kind of the poster child for rotation because it's just been so out of favor. And we do like Boston Properties, also pretty well hated because it's in the office sector, but it's in the gateway cities like New York City, where I'm right now. Tremendous demand for high quality offices, not low quality, and very high cap rates in a great asset class. So we do think that has 30-40% upside. But all REITs are, and I think your funds will benefit that this money coming off the sidelines when rates actually go down versus are expected to go down will benefit these interest rates. Not really interest rate sensitive, but we'll have flows into these yield sectors.
Since you did mention Boston Properties, I do want to give Owen Thomas a plug since I was just with him here in Dallas a couple of days ago at the REIT conference. I had a great conversation with him because I've been using some Owen anecdotes in my meetings this year. If you follow BXP, if you're curious, Owen Thomas, their CEO, has done some fantastic media over the past month or so. An interview with Diana Olick on CNBC that you could find about a 30-minute. He did a 30-minute webinar. David Weston from Bloomberg's Wall Street Week. He's done a couple of great segments in the past few months. And if you follow CRE Daily, he did a great episode of the No Cap podcast in the past couple of months. So for BXP followers, there's a lot of great recent stuff done by Owen that you can get your hands on. All right, Jay, last word to you. What should investors be thinking about? Most important thing to be thinking about in 26?
I would watch inflation and the Fed. It is critical we get rates down and get the housing sector moving again, and avoid slow growth. We're not going to have recession, but avoid slow growth. It's critical we get back to 3% growth. That'll help solve the budget deficit. That will make both voters and investors in better mood, so we don't get some socialistic move in the polls. So watch inflation and the Fed and employment, as you pointed out, because we have an employment-obsessed Fed because they're Keynesians. So we've got to get those rates down. We made a lot of progress, but it doesn't help if we stop at 350 because then the 10-year will be 450, and that's too high, and that's going to keep housing pretty restricted.
Well, Jay, here's your homework assignment for going to the new year. Work your magic with my buddy Chris Sullivan. We need to get you and me in a joint appearance with Maria, focusing a unified front on REITs and income and why that makes sense for all investors heading into 2026. I'm sure Maria would love to do a joint interview with you and me. But that being said, I know that my audience and myself especially are so lucky that you spend time out of your busy schedule to share your thoughts and outlook as we head into the new year. I look forward to redoing this with you here in the next quarter. And I think by the time we connect here in the next quarter, we'll have a new Fed chairperson. We'll have a bunch of economic data under our belt. And I think we'll have a really good roadmap as to potentially what's ahead in 26. So, Jay, on behalf of the entire audience, thank you so much. And we wish you a happy and healthy holiday season and a happy new year.